If you've spent any time in the real estate syndication space, you've heard this line before. Our track record speaks for itself. Sometimes it does. Sometimes it doesn't, and a track record that looks impressive on the surface can obscure exactly what you need to know. In this video I'm going to walk through what a GP track record actually tells you, how to get the real numbers, what questions to ask that most LPs don't, and how to distinguish a genuinely strong operator from one who has been fortunate in a rising market. First, let me make the case for why this matters. The GP's track record is the single best predictor of future performance, not the projected IRR, not the pro forma, not the market analysis. Those are inputs the GP controls and can frame however they choose. The track record is what actually happened. But the track record is also the most manipulable piece of data an LP sees. What gets included, how it's presented, what context is provided, the GP controls all of it. Your job is to read through the presentation layer and get to the underlying reality. Start with the request. Before you review anything, ask the GP for their full disposition history. This means, every property they've sold. Acquisition date, sale date, purchase price, sale price, total capital raised, total distributions to LPs, and realized returns, including IRR, equity multiple, and cash on cash. Some GPs will offer this immediately. Others will offer a curated version, their best deals, or their most recent deals, or aggregate numbers without deal-level detail. Push for deal-level data. The deals they don't want to show you tell you more than the deals they highlight. When you get the data, here's what to analyze. First, the equity multiple on realized deals. An equity multiple of 1.8x means LPs got back $1.8 for every dollar they put in. A 2.0x means they doubled their money. This is the clearest measure of whether the GP actually created value for investors. Be cautious of GPs who quote only IRR on disposition history. IRR is sensitive to hold duration. A deal that returned 1.5x in 2 years can show a better IRR than a deal that returned 2.0x in 4 years, even though the second deal created more value. Ask for both metrics. Second, compare realized returns to projected returns. Every deal had a pro forma. Every deal had a projected return at underwriting. Did they hit it? Most GPs won't volunteer this comparison. Ask specifically, for your disposed deals, what was the projected IRR versus the realized IRR at underwriting? A GP who consistently hits or exceeds projections has calibrated underwriting. A GP who consistently misses, even if they still return capital, is either over-optimistic at underwriting or underestimating deal complexity. Under-projection bias is fine, conservative underwriters deliver upside. Over-projection bias is a pattern worth recognizing before you invest. Third, the live deal portfolio. Realized deals are history. The live portfolio is now. Ask for current occupancy, current NOI versus underwriting, and current distribution status on every live deal. Are distributions current? If a deal is 2 years into a 5-year hold and distributions have been suspended, ask why. If the answer is, capital improvements, ask for the specifics. If the answer is vague or deflects to market conditions, ask harder. A GP whose live portfolio has multiple deals with suspended distributions is operating in difficulty right now, regardless of what their realized track record shows. Fourth, market cycle context. A GP who has only operated in rising markets has never been stress tested. From 2012 to 2022, virtually any multifamily deal in any major market returned positive equity multiples. Rising rents, compressing cap rates, cheap financing. The rising tide floated nearly every boat. A GP whose entire track record falls within that window, with no deals closed pre-2012 or post-2022, has never navigated a market cycle. They may be excellent operators. You can't tell from their track record alone. Look for deals that closed in 2019 to 2020 and performed through the rate environment of 2022 to 2023. Those deals faced real stress. How they performed tells you something meaningful. If a GP has no deals that were tested by market adversity, ask directly, have any of your deals ever underperformed projections? What happened? The answer matters. A GP who has never had a deal underperform is either very new or not being honest. Here are the specific red flags to watch for in a track record review. Red flag 1, aggregate returns only, no deal level detail. We've returned 18% IRR across our portfolio, is not a track record. It's a headline. Ask for deal level data. If the GP can't or won't provide it, that's a flag. Red flag 2, unrealized deals presented as track record. Some GPs include live deals with projected returns in their track record materials, sometimes labeled projected or expected, sometimes not labeled at all. Ask which deals are realized and which are projected. Only realized deals count as track record. Red flag 3, a single large deal dominating the returns. If one deal produced 90% of the track record's value, and it was a unique situation that can't be replicated, the track record is less meaningful than it appears. Ask about the distribution of returns across deals. Red flag 4, changes in strategy that make the track record less relevant. A GP who built their track record on Class B suburban multifamily is now underwriting Class A urban mixed use. Different asset class, different risk profile. The previous track record is partial evidence. Red flag 5, no negative data. If a GP presents a track record with 0 underperforming deals, 0 suspended distributions, 0 missed projections, and they've done more than a handful of deals, be skeptical. Markets create adversity. Good operators navigate it. Bad operators hide it. The questions to ask any GP before investing. 1. Can you provide deal-level disposition data for every sold property, purchase price, sale price, capital raised, total LP distributions, realized IRR, and realized equity multiple? 2. For your disposed deals, what was the projected IRR at underwriting versus the realized IRR? 3. Are all distributions current on your live deals? If any are suspended, explain why. 4. Has any deal you've operated ever returned less than the original LP capital? If so, what happened? 5. What's your longest held asset that hasn't yet been disposed? Why is it still in the portfolio? 6. Have you ever had an LP capital call after close? What were the circumstances? 7. Can I speak with 3 LPs who've invested in multiple deals with you? That last question is the most important. The reference call. Ask for 3 LP references. Not references the GP selected because they're happy clients. Ask to speak with investors from your first deal, your most recent deal, and your most challenging deal. On the reference call, ask. How did communication change when the deal had a rough period? Were distributions ever suspended? How was it explained? Did the GP deliver what they projected? Would you invest with them again, and why or why not? Listen for what isn't said as much as what is. An LP who says, they always communicated clearly even when things were tough, is giving you real information. An LP who says, returns were okay, I guess, and changes the subject is also giving you real information. Here's the summary. A GP's track record is the best predictor of future performance, but only if you see the real data, not the highlight reel. Request the full disposition history, deal-level data, realized returns versus projected returns, and live portfolio current status. Market cycle context, a track record from 2012 to 2022 only hasn't been stress-tested. Look for deals that navigated adversity. Red flags, aggregate-only returns, unrealized deals in the track record, single deal concentration, strategy shift, and 0 negative data. 7 questions to ask, and the reference call to a GP's most challenging deal. The LP due diligence checklist has a full track record section, linked in the description. Subscribe for the next one. We're going to get into the preferred return, what it actually means, how it's calculated, and the variations that matter for your total return. Thanks.